Companies with shares of ownership are currently a broken economic system. Companies are one of the many types of an organization. To understand why these organizations are broken, we first need to think about, at a high level, how organizations should operate. People come together and contribute towards an organization. That might be to provide a service, create a product, do some charity work, or even just to play a local sport in the local area. Regardless of the purpose of the organization, there are some desirable outcomes for all organizations that are easy to agree with. One of those outcomes is that any contributions that get made towards the organization should be treated fairly. Contributions could mean investment or labor that help with starting and operating the organization. None of these contributions should be taken for granted. If all contributions are always respected, it would mean that everyone would have more of a reason to contribute as much as they can to any organization. When it becomes obvious that someone's contributions are not being treated fairly, and some other person or group within the organization is receiving most of the benefit from other people's contributions, well, it can quickly turn any organization into a demotivating environment. The incentives can easily become misaligned. But where is the problem most evident? The answer is in companies that are owned using shares of ownership. And more specifically, you most commonly see the problems emerge within companies that are much larger or that are much more established. You might already know someone in this situation. Someone that works in a larger company and doesn't really feel that their contributions are being properly recognized and respected. They might be making contributions that are having a huge impact for the company, but they don't seem to be getting a fair amount of the compensation that they might have expected when compared to the compensation that other people are receiving. Now, of course, there's obviously a few reasons why this can happen, but one of the reasons is due to the permanent nature of shares of ownership. It is the permanence of these shares that creates the opportunity for people to eventually receive unearned income. Now, let's jump into why that's the case. Imagine someone is starting a new company. There's two founders and one investor that is going to invest $100,000. So there's labor contributions from the founders and financial contributions from the investor. Let's focus on the financial contributions first. An investor will commonly receive shares of ownership for their investment. And these shares are permanent, which means they last forever. The shares give them governance rights, which means they can influence the company's direction, such as who's on the board of directors. Shares also give them compensation rights, and this comes in the form of benefiting from any price appreciation of the shares they own, or from any dividends that get paid out to the shareholders. The value of the investor's contribution is easy to understand. It's known at the time of the investment. In this case, it's $100,000. There is a risk that the company never succeeds, and the investment is completely lost. So, for this investment to make sense, the investor is going to want to receive some multiple that reflects a fair risk-reward ratio. If there was roughly a 10% chance of the company succeeding, the investor would likely want at least $1 million as the reward if it does succeed. And that makes sense, as if the business failed 90% of the time, the investor would be losing their investment in the majority of cases. Now, what rate of return is deemed as fair will be influenced by a few things, such as whether there's lots of other people that also want to invest. The investor has taken a fixed amount of risk, which is the $100,000 investment. Yet, they receive shares of ownership that reward them in perpetuity. For larger companies that have periods of high growth, the amount of compensation the investor receives could far exceed the $1 million that might have been fair based on the risk to reward ratio. In some cases, the investor could receive tens or hundreds of millions as a return on investment, yet they only risked $100,000, and the chance of success was approximately 10%. This is an example of an investment moving from being earned income, from taking a risk to receive a reward, towards becoming unearned income, where the reward far outweighs the risk and the value that was provided. The reward becomes excessive. The other problem is for companies that are around for a long time, and companies that survive for multiple generations is a good thing. But the permanent shares of ownership mean the investor's initial contribution gives them governance rights over this company for eternity. It also means that people that provide contributions in the future could also be compensating this earlier investor for eternity as well. If the company is around for hundreds of years, eventually the future contributions could be rewarding the original investors' children and their children's children, and so on. This can be the case even though the original investment was made hundreds of years ago, and it might have already been rewarded with hundreds of multiples of the original investment. So, permanent shares of ownership can lead to unearned income due to the compensation becoming excessive, and they also lead to stagnation in governance control, as shareholders have governance rights forever. They never expire. The original investor took a risk to support a business that could fail, and there was some rough percentage chance of success or failure. But the risk they took is finite. They won't lose any more money than the amount they invested if the company fails. The finite risk of loss is $100,000. Yet, with permanent shares of ownership, the investor receives shares that give them governance and compensation rights in perpetuity. Governance influence and compensation would be infinite and not finite. In the event the company succeeds, the company shouldn't need to compensate one particular contribution in perpetuity once the investor's contribution has been fairly rewarded. So, this is why ownership needs to be temporary. It needs to last long enough so that anyone's contribution can be compensated fairly. What is deemed fair as a return on investment between the organization and the investor is up to them. The outcome that is important is the governance rights and compensation outcomes are finite, just like the value and the risk of the investment is finite. Shares of ownership don't need to last in perpetuity. The situation is even worse when companies give shares to earlier investors and founders, but then, after a certain point, stop distributing any further shares at all. The future contributions, generally coming from labor, would receive no governance influence or compensation rights in the organization. They are only compensated using salaries, wages, and bonuses from active contribution. Contributions are therefore being treated completely differently. Earlier contributions get to benefit from price appreciation and dividends for eternity, without needing to provide any further contribution at all once they've received the shares. And later contributions are only rewarded from making ongoing contributions, and when they stop contributing, they will receive no further compensation. It's easy to see how that arrangement will lead to situations where investors receive a large amount of unearned income, as there's only a subset of the contributions that are receiving shares of ownership, and they get to benefit from them forever without any further contribution. Now, let's move on to thinking about the labor contributions from the founders. Labor is much more complex than someone making a financial investment. With labor, you can still understand the risk of loss fairly easily. For instance, one of the founders could be doing software development, and they could alternatively receive $100,000 in a similar job elsewhere if they weren't working on this new company using the same skill set. Assuming the founder isn't being paid anything yet, they would be risking $100,000 each year to work on this new company. So their risk of loss for the year is $100,000. The big difference with labor and investment is around understanding the value of the contribution. A $100,000 investment is easy to understand. The value of the investment is $100,000. Nice and simple. You know the full value of the contribution at the time of the investment. Though the full value of labor contributions are commonly not known at the time the contribution is being made. The two key aspects to consider are the performance of the contributor as well as the impact of the contributions they make. Performance is quicker to understand and evaluate. At the end of the year, an organization could review the performance of a contributor to understand whether they have underperformed or outperformed in relation to how much work they got done. Comparisons could be made between their contributions with other roles and any expectations in other companies to get a rough idea of whether they should receive more compensation or not on the basis of their performance. The other aspect of importance is around the impact of their contributions. The impact of someone's contributions is extremely complex, and it could take multiple years to better understand a contribution. Imagine a founder designed a novel new way to create a vacuum. It could take multiple years to see what the full value of that contribution was. The vacuum needs specifications and then needs to be manufactured and shared with the wider public to see how popular it's going to be in the market. It'll take time for a new company to scale up production of this new vacuum product. It might take 5, 10, or 20 years to better understand the impact of any given contribution. But it also will be rare that it's going to take forever to understand the impact of a given contribution. There is at least some reasonable amount of time that should be enough to understand most or all of the impact that was generated. So, labor-based contributions need to be rewarded with shares of ownership that enable them to be compensated in the future, when the performance and the impact of their contributions can be better understood. The key thing to remember is at some point in the future, the contribution can be properly rewarded. And after it has been rewarded, the shares of ownership for that contribution can lapse and expire. If they don't expire, the contributor would receive compensation in perpetuity. The contributor would also receive governance rights to influence how the company is operated forever. And if all labor contributions received some amount of permanent shares of ownership, it means you would have this ever-growing amount of shares that have ongoing influence over the company. At some point, the previous contributions will outweigh the future contributions that are being made, and people from tens or hundreds of years ago would be governing an organization that they might have never contributed towards themselves. And that's because the shares of ownership can be passed down through generations to children that have never contributed towards the organization. Or they could be sold to someone else who has also never contributed towards the organization. Shares of ownership need to be temporary. They need to eventually expire to make way for future contributions. Contributions don't need to receive compensation or governance rights in perpetuity. It is the permanence of shares that can eventually lead to people receiving an increasing amount of unearned income and a growing amount of stagnation in who governs the organization. At some point, earlier contributions can be excessively compensated and the ongoing governance influence in the company becomes unfair and unnecessary. It's also important to consider that permanent shares of ownership are not problematic in every company. Consider a solo founder working on their own business. In this case, it doesn't matter how the company is owned, as it's just one person who's contributing towards it. Whatever income is generated in the organization is income that the contributor will receive, as they're the only one in the business who has contributed towards it. Small companies might also not ever face much of an issue with permanent shares of ownership. For instance, service-based companies might distribute all of the income generated amongst all of the different people in the business that provided the service. So the share price might not ever appreciate, and dividends may never get paid out. Now, there's still a small caveat there, and that is that the service business would still be worth something due to its assets and customer base. Someone who buys the business wouldn't need to buy certain assets or build up a new clientele. So the compensation part might not be a huge issue, but there is still some potential for unearned income. More importantly, there is still the problem of governance rights that last in perpetuity. Someone could be providing their labor in this service-based company for years or even decades, and they might not ever have any influence over how the company is operated. And this could be due to them not having any shares of ownership. The most common situations where permanent shares of ownership are more of an issue will be when the company has been around for a long time, or when the company becomes much larger in size. The longer a company has been around for, the more the historical contributions could be problematic, as they will have permanent governance and compensation rights in the business. And this is even though the contributions could have been from decades ago or even longer. The larger a company becomes, the more likely it is that earlier contributions are excessively rewarded beyond what was fair and reasonable. Both of these situations can lead to unearned income and an excessive duration of governance influence. Ownership of an organization should be based on all contributions and not just a subset of the contributions. Temporary shares of ownership help to solve the unearned income problem that can eventually happen over the long term. Temporary shares of ownership also help to align the incentives with always rewarding people that are actively contributing towards the organization. This is instead of perpetually compensating historical contributions that might have already been rewarded fairly. Temporary shares of ownership also help to ensure that the organization is governed and operated by people that have contributed towards the organization within some reasonable period of time. Another problematic area within organizations is the process that companies use to record, measure, and evaluate contributions. You need to do that if you want to understand the long-term impact of any given contribution. Obviously, this is non-trivial. Measuring and evaluating the impact of a contribution is one of the most complex parts of fairly rewarding labor over the long term. Rewarding people fairly based on the full value of their contributions is a compelling way to align the incentives to attract and retain top-performing talent. Developing solutions that help to improve this incentive alignment could have dramatic implications on improving the productivity of companies worldwide. For now, that's all I'm going to say on the importance of understanding the impact of contributions. In reality, it deserves some dedicated content that will be completely focused on that topic alone. The final thing we should mention is around the topic of compounding returns and consolidations in ownership, which was very relevant to both land and money. Can shareholders generate unearned income and keep accumulating more shares of ownership? Yes, in some cases, such as if they were receiving dividend payments. Shareholders could take those payments and buy more shares, which leads to more dividends in the future to buy even more shares. But organizations are not scarce. There are many organizations competing with one another in a variety of different markets. People don't need to own shares in a specific company like they need to use land and money to live and work in society. So, compounding returns and consolidation in ownership isn't really a huge problem for organizations. The bigger problem is how existing shareholders can receive excessive amounts of unearned income over the long term. The key takeaway is that permanent shares of ownership are a broken economic system for structuring companies. This approach to shares of ownership can eventually result in excessive amounts of unearned income and unnecessary amounts of governance influence over an organization. Temporary shares of ownership is a solution that fixes these problems of how to fairly structure an organization for the benefit of all of the contributors involved. Next up, we'll talk about governments. See you soon.